Welcome to the Greater Central Florida Multifamily Investor Group, where we focus on investing where it makes sense. Here's your host, Ismael Rey Reyes. First, I'd like to welcome everyone to the Greater Central Florida Multifamily Investors Meeting, where we focus on investing where it makes sense. Sounds easy. It's not always so easy. People get it wrong all the time. I'm your host, Ismael Rey Reyes, and our goal in this meetup, it's monthly, is to help each other do multifamily deals with a focus on Greater Central Florida assets or potential investment partners. And so today, Beau's going to talk to us about the state of the Greater Central Florida multifamily market, and given its favorable seller conditions that have been going on for too long, how to win the deal. What I'd like to do before I formally introduce Beau, although it sounds like he knows everybody more than I do, I just want to talk a little bit about, I want to set the conditions more than anything. Military people, we always talk about setting conditions. And so I want to set the conditions about what we're seeing here in Central Florida. This is a little video that I picked up 4 days ago about really what a lot of people have been seeing, but now it's becoming much more closer to reality. And I just kind of leave it there.
This is a live look at I-4 in Polk County between Orlando and Tampa. There's a lot of open space there, but it might not always look like this forever. A developer says Tampa and Orlando could actually merge and become one giant mega region.
Fox 35's Dave Puglisi is looking into those possibilities.
Mega region. It's where geographic regions connect and overlap so much that it becomes hard to see the difference between the borders. Some experts believe that Orlando and Tampa may be the next mega region, similar to that of Miami and Fort Lauderdale. Experts say this can bring great financial reward.
Orlando 10 years ago is not the Orlando that we live in today.
The Orlando metro area has rapidly expanded over the last 20 plus years. Its footprint pulling in the suburbs that now contribute to Orlando's growth.
There's people that live in St. Cloud, live in Kissimmee, live in Winter Garden, and for their friends across the country, they tell them that they live in Orlando.
The same thing is happening in Tampa Bay. Developer Fletcher Moore predicts those two areas will combine to create the next mega region.
Those two regions were starting to do the same thing that I saw Miami, Fort Lauderdale, and now into Palm Beach doing, and that is everything in between, gone.
Moore believes much of this has to do with business moving to Central Florida, along with young professionals. Couple that with good schools and strong infrastructure, you have a recipe for success.
All of that's lending itself to more and more recognizing the Central Florida region, Orlando, as the next mega boom.
Transportation also plays a key role in forming a true mega region. Central Florida Expressway authorities have proved to support Brightline's planned expansion from Orlando to Tampa is the next big step.
I think we will continue to grow, but we need to make sure that we grow in a smart way and a sustainable way. So that means a lot of urban infill rather than just sprawling growth.
I know there's a lot of stuff going on here. If for those that have been paying attention, just to kind of follow up on the Brightline, they're already laying tracks to the airport. The idea that we're going to push the Brightline all the way to Tampa is more about how and where, and as far as the time goes versus whether it's going to happen or not. Right now, there's a couple of routes they're looking at, but that's going to open up, just about everything here in Central Florida, even more. So just a lot of good things going on. And I would say it's not just Florida. Before I turn it over to Beau, it's really just almost everything in Florida is just hot. Politically, we are, we're very pro-business, and I won't pontificate on those things anymore. We can talk about that afterwards if people want to stick around, but it's just a lot of goodness here and in Florida all around. So I'm going to transition here to give Beau the proper introduction. And then turn it over to him. Beau Beery has been in the commercial real estate business in Florida since 1999. He earned a bachelor's degree in marketing and a master of science degree in real estate from the University of Florida. He also holds the prestigious Certified Commercial Investment Member CCIM designation. He is regularly asked to speak at industry conferences and to private companies. He also has an ever-growing YouTube channel called Beau Knows Multifamily, where he guides viewers on how to buy more multifamily assets, how to sell them, and how to conduct market analysis. His tours of new listings are very entertaining and widely subscribed. In 2011, he acquired a partnership interest in a Coldwell Banker commercial franchise, where he was consistently ranked as the #1 multifamily producer in Florida for the Coldwell Banker commercial brand, and among the top 5 in the nation every year before he started his own private multifamily brokerage firm in 2021. So it's a ton of experience. I'm happy to have him here.
All right, so I'm a super nerd on stats. My website is full of everything you can possibly imagine. I track everything in the trailing 24 months on my website. It has every property listed, what they sold for, dollar square foot, gross rent multiples, all that stuff. And we update the sales part of it every 2 to 3 weeks. And then twice a year, we do all kinds of number crunching to see how the market is moving. And so I'm just going to be randomly going over a bunch of stats because I still have it all on my spreadsheets. Not all of it has made it to the website yet. And so I'm going to be going over some raw data. Now, what I do is I always track everything in trailing 5 years on some of my market spreadsheets. Let me just give you some cool numbers on what's happened in the market. So when I combine the northern half of Florida, which is everything except Orlando, I always take Orlando and I put it to the side because Orlando is just, it's on crack. I mean, it doesn't make any sense. And specifically for those of you on this call, my guess is the vast majority of you buy under 100 unit deals, right? And Orlando is such a 100+ unit heavy deal, and the metrics throw everything off. So all the markets I'm talking about are Polk County, Marion County, Ocala, Gainesville, all of Volusia County, Daytona, New Smyrna, Ormond, DeLand, Deltona, St. Augustine, Jacksonville, over to Tallahassee, Lake City, and all those little small towns in between. It's all of that. The only thing that's not in there is Pensacola, Orlando, Tampa. Those are markets tracked totally separately. For instance, in Orlando, the current trailing 12-month overall closing price a unit, which is actually down since COVID, but ramping back up very quickly, the average closing price is $182,000 a unit, right? Now that's across from Class A all the way down to you get shot at in Class C minus, right? Whereas the entire rest of the northern half of Florida, the average closing price is $90,000 a unit, right? I mean, totally insane. So that's why I always track it totally separately as I'm going through stuff. So right now, on the 100+ units, the median closing price a door is $112,500 a unit. That's median, right? Again, that's between all the A's and the C's and everything. There's only been 39 transactions over 100 units in the entire northern half of Florida for over 100 units for year to date. 39, right? So that's going through August. September numbers will be done a little bit towards the end of October. So one of the things I want to talk about is we always see when we all go on LinkedIn and Facebook and we go to the different groups, we see all these closings and our brain thinks that people are buying things left and right. And why aren't I buying things? And I'm writing all these offers and I'm doing all these things and we just can't pick up deals. But every time I go on LinkedIn, you see closing. What happens is the brain isn't separating the fact that all the people that you're connected to are from all over the country. So they're closing in Ohio, California, New York, Texas. And you don't really think about the fact that in any one market, or in this case, the entire northern half of Florida, only about 4 or 5 deals a month over 100 units have actually happened, right? And under 100 units, it's 62. So 62 divided by 8, that's like 7, 8 deals a month for the entire northern half of Florida, right, that have happened all of 2021 in all those cities I just listed. That's it. And of those 7 or 8 deals, how many of those were in locations none of you would have bought anyway, that were at prices you never would have paid, that maybe were of construction type you never would have considered, There's just all kinds of other factors that would have narrowed down. But what I have found is that based on any one person's criteria, and I've done this a gazillion times, for the entire northern half of Florida, there's less than 2 deals a month that usually match your criteria that you could have had a shot at. And there are thousands of investors from around the country after those same 2 deals a month. That's a fact. Now, I don't tell you any of this stuff to disappoint you. I'm actually telling you to encourage you, because most people will never tell you these kind of stats. There's certainly no brokers I know that track stats the way I do. Most investors don't track the way it is, because it takes a lot of time. You have to have dedicated people to just do that. But by knowing how rare closings actually occur, it allows you to last longer in this business. A lot of people get started in the business and they write lots of offers and they're working hard and they're showing up to properties and they're underwriting deals, and they do it for 8 months straight, 12 months straight, don't do a deal. And they're just like, I'm not doing this anymore. The brokers just had the prices too high. Sellers are crazy. They make up all the excuses why they haven't picked up something. The reality is they may have been doing a lot of things correctly. They just haven't stuck around long enough. They haven't underwritten, or mostly they haven't been sent enough deals by all the brokers, right? Because it's all about brokers are doing all the deals. You have to be on their list. So some more stats, right? Now, we'll look at under 100 units. I'll just keep that. I'll keep it to that. The average closing price under 100 units right now for the northern half of Florida through 2021 is $82,000 a unit. Now, that is up 83% since 2015. 2015, that same complex was selling for $40,563 a unit, which at the time was a 5.08 gross rent multiple. Now, for those of you who don't know what a gross rent multiple is, I don't track cap rates. I think cap rates are stupid. They make no sense. It's never something you're ever going to experience. It's that seller's income minus the seller's vacancy minus the seller's expenses equals an NOI that you'll never have divided by a purchase price, right? You're buying this to make improvements, and most of the expenses that seller has, you're not going to have. So I don't track cap rates. And plus, even if I did track them, you're never going to get an honest answer from the seller, the buyer, or the broker. Not going to happen, right? And gross rent multiples are not a great factor either, but it's at least a metric that can be truthful, because it's simply price divided by annual in-place rent. And the annual in-place rent you can get fairly easily. It's usually apartments.com average rents are about 5 to 7% higher than in-place rent rolls, right? So gross rent multiples in 2015 were 5.08. They are currently 9.3, right? Which is a 30%, I think it's a 36% increase since, let me make sure that's correct. Yeah, no, it's my bad. It's an 83% increase. It was a 103% increase on the price a unit. Now, what's interesting is if you look at compared to 2018. So 2018 was the most highly traded year yet. 88 transactions in the northern half of Florida for under 100 units. And the closing price was $59.4 a unit. The gross rent multiple was 6.85. However, as of today, that's a 39% increase over 2018 and a 36% increase on the gross rent multiple. Now, the other way to look at gross rent multiple is that for the same dollar in rent. So for instance, in 2018, now in 2021, for the same dollar in rent, people are now paying 36% higher than 2018, because gross rent multiples even out years. Years don't matter. It's the same dollar of rent. So 36% everyone's paying more than 2018 for the same exact dollar of rent. Doesn't change at all, right? And year over year, we've gone up 13% on the price since 2020 and 19% on the gross rent multiple, which means we're now paying even more for the same dollar in rent. It actually jumped from a 7.85 last year to 9.3. It's pretty crazy, right? Now, across, I track classifications, right? So I don't just do A, B, C. That's too broad of a classification. I look at A, B plus, B, B minus, C plus, C, C minus, and I track affordable housing completely separately. So there's been 171 transactions in the trailing 12 months. I just gave you the first 8 months, but the trailing 12 months, there's been 171 total transactions of anything over 10 units, okay? And I told you the average closing price is $90,000 a unit. Now, the Class A average is currently $218,000 a unit. Now, almost all the A classes are new construction, right? It's usually between 2018 and 2020 right now. Now, that's trailing 12 months. I'm here to tell you that the new construction prices, not including Orlando, is now between 240 and 280. I've got Gainesville deals closing right now for 260 and 285 that are on the market and going to contract. I'm not a part of either one of those, but I just know about those. And I consider Gainesville and Tallahassee secondary markets. I consider Orlando and Jacksonville primary markets, and markets like Ocala, Volusia County, Polk County as tertiary markets, right? So just a secondary market like Gainesville, we're already seeing 260 to 280. On the Class B plus, that's about mid-2000s age, call it 2003 to 2009, 2010. Those are running 180 a door with an average $1,400 a month rent. Class Bs are roughly mid-1980s, closing at 141 a door with $1,150 a month rents. A B minus is in the 70s for age, closing at 106 a door and $950 a month rents. And I won't give you all these. I'll give you C plus and then stop there. The C plus is mid-1970s, closing at almost 90 a door for a C plus, and that's $845 a month rents, right? So almost everything has really jumped. Even a C plus is at an 8.74 gross rent multiple. That's pretty insane. Let me give you another crazy stat. A C minus, which is the worst place you want to walk around. You don't want to be there. It's a rough place. Might even be some boarded up buildings on property. It's 1960s product. Average close price right now is about $40,000 a unit. Average rent is $575 a month. The average gross rent multiple is 6.64. And let me give you a comparison. The average closing price gross rent multiple for over 100 unit deals, which are better than under 100 unit deals in terms of all the metrics, in 2015 was a 6.0. So C minuses today for anything over 10 units are trading a good clip above 100 plus unit deals in 2015 on the gross rent multiple. That's insane, right? And then on the, I'll give you some more new construction stats. So in the year 2021, we have sold 22 new construction deals. That's across all of the entire northern half of Florida, including Orlando. And by the way, most of those were in Orlando. So 22 transactions. That comes out to $1.5 billion in volume. Average size deal was 282 units. Average closing price of those was $240. Now remember, that's now for 2021. The ones coming up for the fourth quarter are going to be 240 to 280. The average rents of those deals were about $1,700 a month. Orlando's running about $1,850 a month. And $1 a square foot is also pretty considerable. You're looking at $230 a door, or excuse me, $230 a square foot. And the gross rent multiples on these new construction deals are running just below 12, right? Pretty high. And then let me see if I got some other stats for you. So here's some interesting stuff for you guys. under 100 unit deals. Let's talk about inventory. Inventory is super important. I get a lot of newbies that call me up and they say, hey, Beau, I'm interested in buying stuff in Daytona Beach. I'm looking for, under 30 unit deals. Do you have anything? And what they don't understand is you have to cover a huge geographic area in order to have enough number of transactions happening based on the market share you believe you could capture to do the number of deals you want to do. And if I, as a broker, have to cover the entire northern half of Florida in order to do what I do, which is about 12 to 15 deals a year, that's about all I can handle as little old Beau Beery with no big giant team, then I have to cover the northern half of Florida. You have to cover a number of markets, probably the entire northern half of Florida, right, in order to do that. I only compete against 55, 56 other multifamily brokers. And as you know, the 80-20 rule, 20% of us, or about 12 of us, do the vast majority of the deals. So really, I'm competing with about 10 or 15 guys, that's it, in order to get my 12 or 15 deals. You're competing against thousands of people. So you've got to cover at least a northern half of a state or an entire state to have a chance. You just have to. So under 100 units for the entire northern half of Florida, not including Orlando, there are 756 apartment complexes. So between 10 and 99 units, 756 complexes, 25,000 units. Average size is 33 units. And about a third of those are in Jacksonville, right? Jacksonville has the same number of units as Gainesville and Tallahassee combined. Average ages are about 1980. There are 562 owners in the world that own those 756 complexes, which is about 1.3 complexes per person. That's it, 560 people. I know every single one of them by name. They know me. And that's how you want to get. You want to get to where you know all 756 of these complexes. Now, here's interesting. 62% of that inventory is 40 years old or older. And in Jacksonville, 76% of those complexes are 40 years or older. Now you say, well, gosh, why is it so much higher in Jacksonville? If you think about primary markets, Jacksonville and Orlando, before 1980, you could build on 2 or 3 acres a 20-unit complex because you could buy the land for a price that makes sense. Today, you can't do that. You can't buy 3, 4, 5 acres in Orlando and Jacksonville without putting at least 200 units on it. And that's been that way for the last 40 years. So all of the small inventory in Orlando and Jacksonville is very old. So that's why, for instance, in Orlando, for all of 2021, guess how many deals have been done under 100 units? For all of Orlando, I'm talking about all the counties surrounding Orlando. Let me give you let me make sure you understand what I'm talking about for the number of, I'm not talking about just Orlando property. I'm talking about Lake Mary, Claremont, Kissimmee, Sanford, Champions Gate, Winter Park, St. Cloud, Winter Springs, Oviedo, Altamont Springs, Castleberry, Eustis, Windermere, Apopka, Leesburg, Fern Park, Ocoee, Groveland, Lady Lake, Tavares, and Eatonville. How many closings happened under 100 units in all of those cities for Orlando? 12. Now, you may be thinking, Beau Beery don't know what the hell he's talking about. Ray, I don't know why you brought this dude on here. I know people who are buying complexes left and right in Orlando. It's horseshit. It ain't happening. What you're seeing is people in different parts of the country closing on things. Only 12 apartment complexes between 10 and 99 units that have occurred in all those cities in Orlando, and that's it. Now, you may not even buy 80-unit deals. Let's talk about just under 20-unit deals. Maybe some of you on this phone are just buying between 10 and 20-unit deals. There are 1, 2, 3, 4, 5. Only 5 deals in all those places in Orlando that have happened. That's why you got to cover the entire northern half of Florida. And in Jacksonville, that number is 18 deals. That's it. In Orlando, over 100 units, there's only been 44 closings. Now listen, the second half, or excuse me, September through December, these numbers are all going to jump. The market is going crazy. Everyone's trying to fit in these closings before taxes go up next year, even though it's only going up 5 to 8%. There's going to be a lot more closings happening. Now, that 12 deals under 100 units, it may go to 24 or 25. It ain't going to be some big jump, okay? At least in terms of the overall number. So, and then of the newer construction stuff under 100 units, that represents anything that's been built in the last 10 years. Only 3% of the inventory is built in the last 10 years. Now, what's interesting is 34% of under 100 unit deals have already sold since 2018. Now, why that number is important is the odds of you picking up something that's sold in the last 3 years and adding value and then being able to sell it again for more profits is unlikely. 34% have already sold. Now, if you think about loan terms, most loan terms are 5, 7, and 10 years. And actually, most of them are 5 and 7 years. So at least 30 or 40% have already refied since 2018. And a lot of those have defeasance. You're not going to be able to buy it and pay off defeasance for a right price. So let's just say 60% of inventory is something you can't touch anyway. So of the 40% that remains, you may say, Beau, well, 40% of 756 apartment complexes, what is that, 280 complexes? Again, how many of those are in locations that you would never buy? How many are owned in long-term funds? So those are people who are never going to sell. How many are owned in family estates? They're never going to sell. How many are in a location that is terrible? How many will be at a price that if they did sell, you would even look at? So inventory is really, really important. You've got to cover large enough geographic area. I'll stop there for now, Ray. Let me know if you want to keep going off on numbers or jump into something else.
It's not just a seller's market, but it's like a seller market cubed or by 3, right? It's just not when you get down to it, it's just even harder, which is probably what the most important part you're going to talk about is how do we get at those few that make sense for us, right? And I think that's essentially where we're going. I already said one strategy, which I love, is figure out who's on the broker list and who's high enough that is getting deals before you do. Partner with them, period. You want to be the one that owns it all. Well, I guess good luck getting, competing with them, or get in on the deal with them and be part of it, right? It's a big enough pie in this game, but that's one strategy. But I know you have other ways for those people that do want to get in and be that lead element, whether it's on a 10 unit or 20 unit, et cetera.
Yeah.
So,
all right, go ahead and crack over the next slide, I guess. Let me see what I got here. All right, so love factor. I'm going to try to, this is usually an hour and a half presentation. I'm going to do this in like 15, 20 minutes. All right. So if any of you have not read my book, you really need to get it. I'm not telling you that because I make a bunch of money, because I don't. Anybody who's ever written a book will tell you don't make a bunch of money when you write a book. You need to get my book, Multifamily Investors Who Dominate. That's what the book looks like right there on Amazon, Audible, Kindle. What I talk about is the love factor. And the love factor, if you'll go to the next slide for me. Well, this is where that's what the book looks like. That's where you can get it. Go to the next slide for me. The love factor is the total number of properties that you saw for sale in the marketplace, whether a broker bought it to you, you saw it on LoopNet, a seller called you directly, which never happens, divided by the total number of closings. Like, so for instance, if you were buying in just Orlando and you didn't listen to anything I just said, and you were trying to buy in Orlando under 100 units, and I showed you a list of those 12 closings, if you only saw one of those, you have a sucky love factor, which means the brokers aren't thinking of you. Brokers are doing 93% of all these transactions, and it gets higher and higher as the size of the deal goes up, right? So if I showed you 100 closings and you saw 70 of those during the year, that's a pretty good love factor. The whole point of the story that you're trying to accomplish here is you just want to have the most number of at-bats possible, right? Most of you probably know how to underwrite, and you got good financing. You got Ray on your side who can support you on equity and can bring you in and do all these things. But if you don't see the deal, you never have a chance. And the guys who are best at this are seeing every single deal, oftentimes before it comes to market. And in order to increase your love factor, it's all about networking with the brokers. That's the highest quality thing you can do, right? You can take one guy who all he does his entire life is try to call that seller at the exact moment directly and catch them when the husband or wife just died and they've been left this property and they don't want to manage it and they're going to sell it to you for 10% below market. You can try to be that guy, right? And you may make more profit than the guy who goes after all the deals that are on the market. But this guy who goes after brokers and is networking like crazy and goes after every deal that comes to market is going to own 87 times more deals than this guy. This guy may make just a bunch of base hits and you may get home runs, but you're a tiny, tiny guy compared to this guy. And it's all about how big you can get. The more number of deals you own, the more number of units you own, the more powerful you are. Because when I present multiple offers to a seller, who's that seller? If you put your seller cat on, who is he looking at? The guy that owns 8 complexes in Orlando and I'm selling a deal in Orlando? Or the guy that owns 1 duplex in Nebraska, right? It's about getting more powerful, and love factor is important. Next slide, please. All right, so this is a silly, thing I have to even go over, but one of the biggest reasons you aren't seeing deals besides brokers not thinking of you are spam blockers, right? So this is not fun, but this will open up how many listings you see, I promise. Long story short, the world runs on servers, right? So as a multifamily broker, I send out lots of emails. And what happens in the ordinary course of business, even though I use third-party email systems to protect me, servers eventually throughout the year sometimes will blacklist me and you don't even know about it. So there's a world server that my email goes to first of all, that takes care of that basically hosts your email. And then if it says, okay, you're good, I'm now going to send this email to Ray, and then it comes to Ray's computer, and then Ray's computer decides whether or not it goes into junk folder or goes directly into his inbox. But if it never even makes it past the world server, because I got blocked, you'll never see it. And then when it goes to your computer, if you aren't checking your spam blockers, or if you haven't whitelisted every broker in the market that you cover, you'll never see it. So here's what I advise. If you have a company email, in other words, a non-Gmail, a non-Hotmail, or something like that, get with your IT server, add every broker's email to the whitelist. You may not be getting their listings now as it is. They might be actually trying to send it to you, and you never even know about it. If you have Gmail or Hotmail or one of those services, then you can usually just right-click on emails that have gone to spam and then send them to your safe senders. I'm telling you, this will free up a dozen deals a year, this alone. I can't tell you how many times in my career some guy calls me up and is pissed at me because I sold a deal that was right next to a complex that he owned, that I, of course, sent him the deal, and he just never got it. And I can't call everybody on my list. That would be ridiculous. If you don't get my email, I only call specific elite investors to make sure they got it. I can't call everybody. Okay, next slide. All right, go to the next slide. So one of my tips is concentrating on Class B assets, but I don't want you to not concentrate on Class Cs. I did a study, long story short, what this slide is saying is that to go from a C minus to a C to a C plus, a C plus to a B minus, usually has about a $15,000 to $20,000 per unit jump. So if you bought something at $70,000 a unit, that's a C, and you put $5,000 a unit in it, you could resell it for $10,000 to $15,000 a unit. Great. But if you go from a B minus to a B, there's a $38,000 jump. B to a B plus, there's over a $40,000 jump. And B plus to an A, another $40,000 unit jump. There's the characteristics there. You can share these slides, later on. But B class closings happen nowhere near as much as C class closings. So I don't want you to stop looking at C's. There's still good deals there. It's just that when you see B classes, 1980s, mid 2000s, they've got rents of $1,100 to $1,300 a month. Pay attention to them, because if they're in the right locations, you can have big jumps in values. You could put in $10,000 to $15,000 and still make 20, 25 plus on the back end sale. Next slide. That was just an example of a perfect example. In 2013, guy bought a B class deal for $130,000 a unit, resold it 2 years ago for $190 a door at a B class renovation. Awesome deal. That's over in Jacksonville, I think. Next slide. We already went over this, cover enough geography. Go to the next slide. I basically go into a number of examples of why you want to have enough geography so you have enough probability to be able to actually close on one of these. Tip number 4, stop looking at cap rates. It's all about the IRR. What I mean by this is many of us get these listings that come across our desk from brokers that have 4.2 cap, 4.8 cap, 5.4 cap. And a lot of you have just been trained to be like, you're just like delete, right? You don't want to do that. I've told you cap rates are stupid, especially when you don't want to put, whether or not you look at a deal or not in the hands of a broker who you have no idea how he calculated that cap rate, what he put into it, what the seller has into it, what kind of value you can add into it. I'll buy a 3.8 cap all day long as I can add the right value. It's all about IRR, right? Pay attention to IRR. Look at every deal that comes across your desk. If there's only, whatever it was, 12 deals in Orlando or whatever it was for the entire market that are happening in an 8-month period, you got to look at all deals. Sometimes there's gems in 4 caps if the rents are truly $300 a month underpriced. So don't pay attention to cap rates. Do your full underwriting. Look at your IRR. Look at your cash on cash. Next slide. All right, touring the asset. So when a new listing comes out and there's a call for offers, if you're remotely near within a few hours or 4 hours or 5 hours of a deal you're looking at, go tour the asset with a broker. That is super important because, again, when I'm presenting offers and I have 10 offers on an Excel spreadsheet that have a whole bunch of different columns, here's what the person offered, price a unit, their due diligence period, the closing period. I even have a column that says, did they tour the asset for my seller, right? If you have your seller hat on and you've got 4 offers of 10 that are very comparable near ask price, and 2 of them have never toured the asset, who are you giving more weight to? Plus, when you meet with the broker and potentially the seller sometimes comes, man, what a bond you can build. Go tour the asset. Really, really powerful. At minimum, in between going to, in other words, if you go to call for offers and you made it to best and final, definitely take the flight. If you're a flight away, definitely come and tour that asset, because now you're down to call for offers. That could make or break whether you've toured the asset. Nobody wants to go to contract with a guy who's never even seen the property, for God's sakes. That's Russian roulette. Why would you do that? Next slide. Bio package. I'm not going to go deep into this, but go on my YouTube channel. I have a playlist called like investing for beginners or investing for newbies or something like that. Find this video. It's a 2-part series on what new investors should do, from how you find lenders to how you build a bio package to all that. When you submit offers, I think you should act like you're buying your home. And like single family salespeople these days are having you put together cover letters and little pictures of you and your family, whatever you can do to win deals. Bio packages should be roughly the same way. I want to have a picture of you. Talk about what you do as a job and how it applies to buying apartments. List the assets and the addresses that you own. Include letters of recommendation from brokers or bankers. If you haven't done deals, still get letters of recommendation from your bank. Maybe they can talk about the kind of assets you have and the liquidity and so forth. Anything to separate you from other offers. Next slide. That video, though, will dive pretty deep. Go ahead and skip through all this, cover letters, all this stuff. All that will be in my video. All right, no informal offers. So I get this all the time. It's like buyers are sort of testing, so they'll send me an email that says, hey, Beau, did my underwriting. So my offer is, 2.2 million, probably do a 30-day due diligence, something around a 45-day closing. Our deposits are 1%, right? And it's like literally just in the body of an email. It could have maybe even been a good offer, but if it was in an email form, it just shows that you aren't for real. You certainly don't want me to forward that to a seller, because that's exactly what he's thinking is you're a rookie, you're not serious, you're going to cut corners, you're never going to show up to closing. Turn in full letter of intents. Next slide. All right, next slide. So this is some good meat and bones here. All right, some of this stuff you're not going to like, okay? Almost every deal, unless it's got a ton of hair on it, the winner has no financing contingency. Now, I'm not advising you to do that, especially for some of you who are newer. You certainly don't want to put up $50,000 deposit on $1 million deal, right? And put no financing contingency, and then something comes up and now you're hard on deposits and you don't want to close and lose 50 grand. I'm just telling you that you need to start working toward, in your career in this business, developing a good enough relationship with enough lenders where you trust how they underwrite and that they're going to have you the loan package in time for closing, and that they trust you enough in your underwriting to be able to produce the kind of terms in time for no financing contingencies. Now, very rarely, even when people turn in offers and they say they're paying cash, hardly anybody ever pays cash, even the richest people on earth. Loan terms are too good. All they mean when they say cash is that they're not making the deal contingent on financing. But again, because every deal has multiple offers, out of 12 offers that come in, probably 7 or 8 of them will have no financing contingencies. And if you're a seller in a hot market, do you want to choose the guy who isn't going to be conditioned on appraisal or isn't going to be conditioned on loan to value? You're going to choose the guy who's making the whole deal contingent on whether or not he gets approved for the loan. Common sense. So keep turning in financing contingencies until you're rich enough with your lender, and you need to get enough churn and burns to develop, a reputation and experience, but you need to get to where there's no financing contingency to win deals. Huge deposits. Listen, I don't know what happened in the world, but some guru a long time ago said, put down 1% in deposits. Never made sense to me. If you're looking at a $3 million deal, I don't want to see $30,000 deposits. That means you're not a player. On a $3 million deal, you're going to have to show up to closing with $1 million in 60 days. Why would you put $30,000 as a deposit? Go ahead and put 150 grand, put 200 grand. Why? Because a lot of your competition is doing this 1% dumb rule of $30,000 or $30,000 or $15,000 initial and $15,000 second closing. It shows the seller you don't mean business, and that the seller wants it to be painful for you to back out. They want to know you're going to show up to closing, right? So use this opportunity to put down the money you're already going to be putting down in 60 days and make yourself look big. 30-30 on DD and closing. Almost every deal is a 30-day due diligence, 30-day close. Anything more than that, you risk you put yourself at risk at not being competitive. Because this is not about what will the seller accept. It's what is your competition going to be doing. Now, if you're buying a portfolio, if you're buying 6 properties in Orlando, 45-day due diligence is probably fine. If you're buying 6 properties in 4 different markets, 60 days is probably appropriate, but almost every deal is 30 and 30. No closing extensions. Brokers don't like to see this, and sellers certainly don't. And what I mean by that is you got a 30-day due diligence, 30-day close, and hey, for $10,000 extra deposits, I can extend the closing for 30 days. If you were the seller, you don't like to see that, and your competition ain't doing it, or at least the ones who are going to win it, right? So if you truly need 45-day due diligence, put 45 days. The 30 plus the 15, it just feels like you're already asking for something during the transaction, right? Don't use business days. It's like another cheap thing to do, right? When someone says, I'm going to have you my deposit in 5 business days. I'm going to do a 30-day due diligence with 30 business day closing. it feels like you're trying to pull one over on somebody. And the seller doesn't fall for that. Nobody falls for it. Try to keep your letter of intent to 2 pages or less. You're trying to make it easy to be accepted. Most of the time, it's some of these REITs and huge companies that have to have 6-page letter of intent. There's no reason for it. Give me a 2-page letter of intent. Next page. All right, pay max price. So what I mean by this is I have a video on this that you actually have to find on my YouTube channel as well. I can't remember what it's called. I'll try to find it here before it's over. But one of the biggest problems I see with investors today of all different levels is that they spend too much time trying to pay just enough to win the deal instead of being true to their underwriting. Here's what I mean by that. If you're home at 10 o'clock at night and you're underwriting a deal and the ask price is $2 million and your pro forma tells you based on the rents you think you can achieve and your expenses and all your underwriting, and you believe you could pay 2.15 million, don't call the broker and say, Beau, so where do I need to be? What are you seeing so far? You know, if I came in at $2 million, is that going to get me the deal? What if I pay $2,020,000? Do you think that will win? Will that get me in there? Don't try to guess what'll get you in there. Come in at the most you can pay, because there are no second chances, right? Now, I don't want you to feel like this is, listing broker trying to get you up on price because I make more money on commission and look good in front of the seller, right? I'm here on this podcast trying to help you do more deals. And I see more deals lost by people who are throwing up after they lost the deal because the price that won the deal, they could have easily paid. But they tried to play the just enough game, right? Because at the end of the day, I'm not going to come to you and be like, hey, Ray, dude, you did a great job, man. Listen, you got second place. You didn't get the deal. But man, you did a great job underwriting this. And because you got second place, here's $100,000, man. Awesome job. It's never going to happen, right? It's like Ricky Bobby said, second place is the first loser or whatever. That's what it is. You really need to be true to your pro forma and you will win more deals that way. Don't be scared. Listen, it's a base hit. Yes, you may not get your 20% IRR. Maybe the $2,150,000 is a 14% IRR. But if that meets your hurdles and can build your portfolio, because size matters as you go up against multiple offer deals, that's what you want. The biggest players in this game, all they do is they just hit base hit and base hit and base hit and base hit. And after 3 years, right, they got 1,000 units. And now they're just killing people, right? Because I, as the listing broker, goes to the seller and say, hey, we need to choose Sam over here. He's got 1,000 units and 400 of them in the same marketplace of this listing. And he's got a good price and due diligence and closing period, blah, blah, blah. Next slide. All right, don't sweat the small stuff. All this means is, once you get into a transaction, you're under contract, stop letting little things as a percentage of the price make you retrade or ruin your reputation over stuff. You're looking at a $2 million deal and you find a $10,000 a pipe that bursts during due diligence. Don't retrade the deal on $10,000. Don't ask for the seller to pay $10,000 or maybe a busted pipe is a bad example, but whatever it is that's minuscule, look at your IRR. Did it affect your IRR whatsoever? Probably not, right? Move forward and be a closer, because being a closer when small things come up and not retrading builds your reputation, and I, as the broker, want to bring you more deals. I can't remember, did I do top 10 or did I do 15? Is there any more slides? No, okay, that's it. All right, I'll stop for questions.
Hey, Beau, I got a question for you.
Yeah, man.
So when you send an email to the buyer and says, hey, you're in the best and finals. I got so many offers and this and that. How many many contracts you have, or how many LOIs you have that that made it to the best and final, just to get an idea?
It's usually between 25 and 50% of offers make it to best and final, right? So if you've got a, for round numbers, if you have $5 million ask price, you're probably going to have some, some 3.8, some 4s, some 4.2s. That'll be sort of the lower half. And then usually the other half are either at ask price or pretty damn close. I have found it to be between 25 and 50% of the total number of offers make it to best and final. And it really just comes down to, it's not a certain percentage of offers that you choose. It's just, it happens to be that there's always a grouping of folks who are very close. And that's who the brokers and the sellers usually pick. If you got a guy who's just way off from the top 5, there's no reason to bring him in the mix. Right. Because even if a guy, let's say he had a $5 million ask price and everybody in the top 5 are between 4.7 and 5 million, and then the next guy is at 4.3, no seller is going to feel good if we bring a 4.3 guy into the best and final, and all of a sudden that 4.3 guy comes to 5. That's a horseshit thing, right? I know that guy's going to retrade. Ain't no damn way he comes up from 4.3 to 5. Okay, he's just trying to get this under contract to win the deal, and he's going to retrade later. That's what it says to me. If you didn't come correct the first time, at least to get you in the best and final, it doesn't feel right.
All right.
Beau, when we talk about building relationships with brokers and being on your list and getting offerings that you have out there,
yep,
wanting to be mindful of your time and deals that we may want to make offers on or not, when is it appropriate to respond to say, hey, this didn't fit well for me on this deal, versus just letting it go? Like, is it a mass email that I'm getting?
Almost always it's a mass email. So when I send out new listings, I've already queried my database, right? So I have taken, tens of thousands of people and narrowed it down to, usually it's no more than about 12 or 1,300 people who want any one exact asset, right? And keep in mind, there could be 6,000 or 7,000, but I cut off a lot of them because they're just not qualified, or I have little labels in my searchable fields, right? And so usually what I'll do is I've already narrowed it down. So when you got it, yes, it's a mass email, but it's a mass email to all qualified buyers who want that exact kind of asset. To answer your question, responding immediately, like, especially if you know you don't want the asset, respond to the broker and say, hey, Beau, thanks for sending it to me. It looks like a good looking asset. Nice job on the package. Just compliment the broker a little bit. It's like any human being on earth wants to be stroked a little bit, right? Hey, the asset doesn't work for me. Please keep me on your list. And I'll always respond quickly, Beau. That's what all brokers want to hear. They just want to hear, hey, you give someone a compliment, you respond quickly, keep me on your list, I respond quickly. I'll keep sending you deals over and over and over again. It's when you never respond ever, right, that you eventually just get removed from the list because I think you're not a buyer anymore. And if you are interested, also respond immediately, like within the hour if you got it. And it doesn't have to be, hey, Beau, I want to buy this thing. Here's my offer. It's just, hey, this looks interesting. I'm going to take a look at this. Awesome, right? Because and I'm sure a lot of brokers do this, I like to also send your emails to the seller to show them your interest, because I want you to look good, right? That you responded so quickly. I can use that kind of dialogue to build your offer later on. If my seller keeps seeing Kelly in my emails, and you turn in your offer, you're fresh in his mind, right? And so, even when you say no, I also want the seller to know. It doesn't reflect poorly on you at all. It gives the seller information about his asset. And I don't forward all the no's and all the yeses to him, just the useful ones, right? So if someone responds back, hey, Beau, great looking listing. I just don't buy scattered site duplexes, but I'm sure you'll sell it. That's a nice compliment. I'll send that to the seller.
Yep.
Right.
And that's why I got all the roofs.
Exactly. And so when someone says scattered site, it sort of reinforces what I already told my seller before the listing. Hey, this one might not get as many offers as usual. A lot of people don't buy scattered sites. And so then when I get 18 people who says, no, scattered sites, I like to share that to my seller. It helps me do a deal. It reinforces what I told them. And the same thing goes for yeses and compliments. And hey, Beau, I drove by the property. I love the annual flowers the guy put on the sign. I would love to be able to take that email from Kelly. I'm going to forward it to the seller. Anything I can do, I can start building you as a buyer. It helps me.
Good. Thanks for sharing it. I've got your book.
Yay! What else, guys? No stupid questions. Kevin, what you got for me? You've been quiet back there. What you got for me? What kind of love can I bring you?
No, just thanks for the information. One of the major things or takeaways that I got is with the pricing, where you indicated about the different offers coming in and the range, like the 4.7 versus the 4.3, which is good information. The only question that I have is if sometimes you're being true to your underwriting and you do have an underwriting that gives you a price that's below listing, should you then still submit the offer or just don't worry with it?
No, great question, Kevin. So, you don't want to lowball, right? That's what you're trying to guard against. And so you just have to use judgment here. So most assets, well, let's just say almost every asset sells, right? So whether you think it's overpriced or ugly looking or scattered site or whatever, I'm going to sell it. That broker is going to sell it. So you don't ever want to criticize a property. But when you're making offers, you just have to kind of, so use common sense. For instance, I've got a 16-unit listing that I just came out with in Gainesville, right? Great little asset. It's 4 parcels, but it's its own subdivision. It's all 2 bedrooms. It's in a good location. That's an asset is going to be popular, right? And so if the ask price is $1.6 million and your underwriting is coming out at $1.2 million, I'm going to have a bunch of offers at $1.5 million to probably $1.65 million. You just have to know that. You have to know enough about what's going on in the markets you're working in order to understand that. And if you don't, you need to study your markets more. So you definitely don't want a lowball. A lowball can curse you in a broker or seller's mind immediately, right? And they'll just think you're a joker. I literally even have things in my searchable database where I literally just uncheck someone, right? And I can even uncheck them for a certain amount of time, right? Because I just don't, especially if they come in, they're just kind of like, hey, I want a 60-day due diligence. I'm offering 1.2 on a $2 million deal. I don't want that guy seeing any more of my listings, right? It doesn't help me at all. He has no idea what he's doing. I don't want my seller. I have to forward that offer by law to the seller, right? But it embarrasses me that he's even on my freaking list. So you just have to pay attention to where offers are. Now, let's just say in that example, you got a $1 million deal and you're coming in at, $750,000, $800,000. Call up the broker and be like, hey, Beau, how are offers coming along? How many do you have so far? What do you think it's going to go for? What kind of activity do you have? Those are totally legit questions, and just listen to what he says. And he may ask you, hey, Kevin, do you think you're going to be offered? Well, I'm still underwriting it. I'm going to get back with you very quickly. I know when the call for offers date is. Just kind of wanted to see where the temperature was. That's an easy way to understand kind of where you are, right? And all brokers will tell you that. We can't tell you what the prices are that have come in, but we can at least give you some guidance so that you don't make a fool of yourself. What else? Jim Snyder, I don't see your face. Ron, Bobby, you got anything? Vessi, anything?
Hi, Beau. Thank you so much for the presentation tonight, and I definitely recommend the book to everyone. Certainly has been a great resource. I have a quick question. To the extent you have visibility, presumably everyone's working off of the same numbers, or people are touring the property and potentially even looking at the same terms as far as deposits, closing extensions and whatnot. So to the extent you have visibility into that, what type of financing terms you're seeing that are leading to multiple offers and oftentimes above asking?
Yeah. So basically, once you get over $1 million loan is when you can get better financing terms, right? So, you know, anything let's call it $1.5 million or more, $1.4 million or more, whatever that comes out to. So typically under 50 unit deals, a lot of newer folks go to their local bank or where they have their money. Banks are the worst, right? Like banks only do 20 and 25-year ammos, and you cannot compete in this business if you aren't getting a 30-year amortization. Now, listen, a 20 and 25-year ammo, of course, allows you to pay off the deal faster, right? It's actually costing you less interest. But the problem is almost every buyer these days is a syndicator, and syndicators need to be able to pay their investors, and paying their investors, they have to have enough cash on cash return in order to do so. And there's nothing of all the lending terms that exist, loan to value, rate, loan term, all that stuff, nothing affects cash on cash more than the loan to value. Plug it in, like go on your pro forma after the show, put in 4% versus 5%, put match the different things. Nothing more than, I'm sorry, not loan to value, amortization period. I'm very, very sorry. Amortization period is the biggest effect, right? And so, most banks are only going to do 20 and 25 years, and even a 25-year ammo will totally make you uncompetitive against everybody else who's getting a 30-year ammo, right? So what I'm typically seeing is always a 30-year ammo. Under 50 units, you're usually anywhere between 3.5% and 4.25%. Most end up between 3.75% and 4%, depending on what your personal financials are. Most terms are 5 and 7. Sometimes you can get Fannie and Freddie that could be full. If you can get some FHA stuff, it could be fully amortizing sometimes, but usually you have to have a long closing period in order to get those accomplished. But the 30-year ammo is the most important. Interest rates, listen, a lot of people try to go after interest. It really doesn't sway much on your rate of return on the interest rates. 4.25% versus 4%, that's not a big deal. You get that amortization period.
Thank you.
It becomes a bigger deal when you're doing 150 plus unit deals on rates, but the amortizations are killers.
I would imagine most of them have a period of IO as well.
Yeah. Most of the time it's between 3 and 5 years right now, depending on the deal.
Hey, Beau.
Yeah. What's up, Steve?
Steve here. Hey, what creative ways are you seeing potential investors get onto yours or any other brokers' lists on their distro lists? What are the, how do we get on more distro lists?
Vessi, what should I tell them?
Read the book.
Read the book. Not to sell a book, Steve. I'm not trying to be one of those guys. It's like, hey, get my book. But the book literally gives step-by-step, like real action plans. And actually Vessi's like a perfect example. I could tell that Vessi's calls and emails to me, and I'm sure to many other brokers, has really stepped up. I didn't know Vessi for shit, 3 months ago, right? And now she's on my list, and we'll eventually get a deal done together, whether it's in, this Friday or in a couple of years, whatever it is. She's on my mind a lot, right? Because she's reaching out to me. And you have to understand there's thousands and thousands of investors. And so what my book teaches in a very small nutshell is you need to be making a list of every single multifamily broker in all the markets you cover. You're going to import all their contact information into a CRM. Every one of you on this call should have a CRM, which is a software that tracks contacts. And you're scheduling every 30 to 45 days, reaching out to these brokers, right? Because you can't remember to call 60 brokers. You're only going to remember to call Beau Beery and the other top 10 guys, right? Because that's what everybody does. But there's 48 other brokers who they may not be full-time multifamily guys. They do office, they do retail, they do land transactions. You have the occasional single-family salesperson who does a multifamily deal, right? And so listen, 60 people to maintain contact with is a lot, but it's only 2 or 3 a day every 30 to 45 days. And you may have between a 30-second conversation to a 20-minute conversation, depending on commonalities. But here's what it comes down to, Steve. What I write about in the book is elite investors. If you can imagine the guys who are doing 10, 12 deals a year, what they've been doing for between 5 and 20 plus years is every 30 to 45 days calling 60 multifamily brokers and talking about business, talking about family, friends, hobbies, loved ones, deaths, hanging out on the weekend, going to car shows, texting each other, going to a movie together. All these things I do with lots of my customers, right? We've developed a bond. But can you imagine doing that with 60 different people for 10 years? Who the hell do you think I think of when I get a new listing before it even comes to market, right? Vessi, when I got that 16 unit listing, you weren't one of my first calls yet. You probably will be eventually because you're doing all the right things. But there are 10 guys that came to mind immediately that I've done lots of business with, that have been calling me for years and years and years, that I know that always show up to closing. They always make me look good. They're always going to do right to the seller. That's who I called before I've even signed a listing agreement. As soon as the seller called me on the phone and said, "Hey, Beau, my wife and I are thinking about selling this," or "Hey, Beau, the REIT, the board members of the REIT were thinking about selling our $50 million asset over in Tallahassee," boom, I'm hanging up. Yo, Ray, dude, I just got the phone call. They own Grandmark over in Tallahassee. Yeah, here's the address. Go ahead and start looking it up, right? So he's got the heads up 3 weeks ahead of time before I've even put together my marketing material, sign my listing agreement. So a lot of these guys, they're able to drive by, and I say guys, just so y'all know, guys means guys and girls. It's a general term. So a lot of these guys, they're driving by the asset. They're talking to their property manager about what the rents could be when they do the post renovation. They're already talking to their contractor about renovation costs. They're doing all this stuff 3 weeks before you've even seen it on your email from me, which is why within 5 or 6 days after a listing goes active, I've already got 7 offers, right? So you're playing catch up. Now, all of you are going to get there. You just have to start this process. I'm telling you, the vast majority of all investors are not doing what I just told you. They're only calling the top 10 guys. And listen, they still make a killing, right? Because the top 10 brokers are doing the majority of the deals. But there's a whole lot of other brokers, and even a residential salesperson, especially for a lot of you who are buying duplexes and quadruplexes and eightplexes. There's nothing wrong with that, by the way. Your world will be residential salespeople, right? Because a lot of those guys are doing those deals as well. They may not be doing 93% of deals. My guess is the under 10 unit world is probably more like 60 or 70% are done by residential realtors. The rest may be directly between a buyer and a seller. But this is all about being efficient with your time. If you spend a lot of your time trying to get directly to seller compared to just making your world about brokers, you'll see way more deals than anybody else.
I think we got time for one more question. Come on.
Don't have a question, but because it sounds like it's in the book. So you just sold another book. Thank you so much for golden nuggets tonight. Thank you for your time.
The audio version is really good too. It's if you get it, I'm not trying to. The audio
That's
version.
an upsell. That's an upsell, Bo.
The audio version, though, it puts importance of voice on certain terms, and then the book has a bunch of different templates too. Go ahead, Jim. I'm sorry.
Name of the book again, please.
Multifamily Investors Who Dominate.
Thanks, Bo.
Yeah, no problem.
And Bo, are you doing the voice on the audio version?
Yes.
As you
yes,
should.
absolutely.
That
So
alone's worth it.
That's what it looks like on there. I know. I read. I can only read books through audio. I don't have the ability to. I don't have the cognitive ability to read. But when I can listen to audio and read the book and look at the chart, I have a bunch of charts in there and graphs and so forth that are very helpful. But hearing the audio voice, you'll hear my different inflections on what I believe to be very important and things you should pay attention to that you may not necessarily get when you read the book.
I just posted the title on the chat. If you guys haven't done it, just make sure you save the chat. There's a way to do that. Just click the 3 little buttons next to where the chats are, the bottom right, and save it so you can get all that and all the other networking stuff that we have on there. So I think we're good, Beau. I think that was good. I appreciate you fighting through the Zoom issues. I just want to give a quick heads up of what we got going on next month, and then we'll do a farewell here. Next month, November 15th, we have something really different for me, even. It's going to be a learning experience. We have Yael Tamar, who's the co-CEO and co-founder of Solid Blocks, who's going to discuss tokenization of real estate. Solid Block is a digital platform for investing in fully vetted property funds. These are fractional investments in real estate projects and other global assets. She's actually going to be dialing in from Israel. So it's going to be like 3 a.m. for her. But interesting topic, completely different. Just a way to maybe broaden out some of the potential ways to get into real estate, which is my favorite way to do it. And with Bitcoin and all these other sort of tokens getting so much attention, that mix between the two is at least something we should pay attention to, because it's moving in that direction. So on that note, Beau, thank you very much for taking the time.
I appreciate it.
That was sweet, man. I appreciate it. Hopefully I may not be in your top 10, but maybe I'm in the top 20, and maybe we'll get that next one after Tallahassee. So we got going full bore on that one right now, and then we'll see what comes next.
You and Vesey and Kelly, I've all met around the same time, and it's just repetition, right? Like it's having those conversations, and we just grow the bond together. That's how it is.
Absolutely. So hey, thank you very much.
All right, guys.
Until next time. Thank you very much.
Thanks, Ray.